One of the most notable developments during the second quarter was the broadening of market leadership. After 2 years of returns driven largely by a handful of mega-cap U.S. technology companies, market participation is finally expanding. Year-to-date, emerging markets have led performance, followed closely by small-cap stocks and developed international markets, all while the S&P 500 continues to deliver solid returns. This shift is a healthy sign. Resilient bull markets are built on broad participation rather than just a few massive players, serving as a clear illustration of why diversification still matters. Market leadership is also shifting within the technology sector itself. While the Magnificent Seven dominated returns last year, semiconductor and hardware companies have taken the lead as artificial intelligence spending accelerates. Although every major tech giant is investing heavily in AI, none of these advancements are possible without the specialized chips, networking equipment, and data centers that power them. Consequently, the physical enablers of this infrastructure have emerged as the primary beneficiaries of this spending cycle, a testament to the fact that market leadership is constantly evolving even within a sector. Energy markets just gave us a textbook reminder of how fast news can move markets. Oil briefly shot past $100 a barrel as Middle East tensions flared, only to slide back toward $70 once supply fears cooled off. While these situations grab all the attention, history tells us that geopolitical shocks usually cause short-term noise rather than redrawing the long-term market map. That's why we tune out the temporary headlines and stay focused on what actually drives returns over time: economic growth, corporate earnings, and solid business fundamentals. Those fundamentals remain strong. Despite higher interest rates and continued uncertainty, the economy has remained resilient. Consumers continue to spend, businesses continue to invest, and corporate profit margins remain near record highs. Over the long run, earnings drive stock prices, and healthy consumers, a resilient economy, and strong corporate profitability continue to provide an important foundation for the market. Looking ahead, we are entering what could become one of the largest waves of equity issuance in decades. The successful SpaceX IPO demonstrated strong demand for innovative market-leading companies. Looking ahead, private AI leaders like Anthropic and OpenAI could eventually follow, giving public market investors access to businesses that have largely remained private. If that happens, investors could see a new generation of market leaders emerge, creating opportunities well beyond today's largest technology companies. One of the primary risks revolves around whether or not there is enough demand in the equity market to absorb these large IPOs. The scale of investment behind artificial intelligence is unprecedented. Over the next 4 years, the world's largest technology companies are expected to invest more than $3 trillion in AI infrastructure, roughly 10% of the size of today's US economy. Naturally, this shift raises questions about whether the AI theme has entered bubble territory. With capital expenditures reaching such extraordinary levels, many investors are left wondering, when will these massive investments begin to yield tangible results, and what will they look like? We believe AI will create both winners and losers, but the long-term opportunity remains significant. The second quarter was defined by recovery, rotation, and resilience. Market leadership broadened beyond last year's winners. The economy and consumers remained resilient despite continued uncertainty. And long-term investment themes like artificial intelligence continued to evolve at a remarkable pace. While headlines will continue to create short-term volatility, our focus remains unchanged: owning high-quality businesses, maintaining thoughtful diversification, and helping clients stay invested in long-term opportunities.